All right, good morning, traders. My name is John Paul, DayTradeToWin.com. It's January 26th. The first month in January is just about over, and we've seen very slow action on the E-mini and probably across the board. But this isn't going to last. I've been saying that volatility comes and goes, and I would expect the volatility to start to increase by the end of the month here, hopefully, right? And so I want to put out this video basically explaining how to trade this slow, volatile, slow market, this dead market that we're having. Today, as an example, you see here a trade that I took. I used the Atlas line here, just show you real quick. And this is a double bar long here for the Atlas line, 1327 quarter, and then the short here that I was late in getting. I couldn't get this short 1325 quarter. But I'm not here to talk about the Atlas line. I'm here actually to show you when and why we should trade when the market's slow or when the market is moving at a good clip. All right, so let me remove this here from the chart. And I'm going to remove here my order. So, all right. So how do you know the market's slow and how do you know the market's fast? Or what is a determiner that tells us that? Well, when I place an order to trade long or short, it's very important to first know what's the market doing. What are the current market conditions? And you've probably heard me talk about in other videos indicator, even though I don't like indicators. This happens to be found in indicators list. The average true range, the ATR, which is right over here. Okay. Now the ATR, when you first pull it up on InterTrader or on other trading platforms like TradeStation, Resignal, or Metastock, MetaTrader, they probably have a preset time. I'm going to go ahead and change that. I'm going to put a 4 or a 5 in here. And what you see here is a line that gives you the average true range of the last 4 or 5 bars. In essence, this is telling you what the market is doing in the now. I don't really care about what's happening an hour ago or yesterday or 3 or 4 hours ago. We need to know what's happening now. And so, whenever you see this ATR at a very low number or very slow, it's a reflection that nobody's trading. This specific market is the E-mini, but we can look at euro, we can look at bonds, notes, DAX, doesn't really matter. Currencies, forex, it all works the same way. Price action is price action. So when you look at this, and whenever you see the market hovering, the average true range on 1 or lower, this is a direct correlation that you should not be trading. So when you should trade is anytime the market is above 1 on the ATR and you have some movement that you can get. But anytime it really falls below this 1 here, I recommend, and I tell all my students, don't trade. The market's dead. And as a matter of fact, if you look at here, when it did fall below 1, what do you have? You have whipsaw, red, green, red, green. This is what occurred. A channel, tightening up of the market. It's not worth trading. It's not worth risking. So in any market that you look at the extreme lows, and if you want to look at it, the extreme highs as well. Whenever the average true range is above 5 here, let me recommend to you to stay out. It's chaotic. Maybe a news event set it off. Maybe there's some type of calamity occurring around the world that's setting this market off. Don't trade if it's too volatile. But really I want to concentrate on the slowness that we've had this first month in January. It's not worth trading. Anytime you see this below 1, you know what to expect and stay out. And so trade when you can, when it's apparent that there's something to get out of it. All of this, what do you see here? Nothing. A slow moving up, red, green, red, green. It's not worth it. Now, if you look at a currency, let me just turn here to a currency. All right, here we have a Euro chart, and the Euro chart is the same parameters, 4 or 5 on the average true range and the ATR, and what you see here are these numbers here, 0.000923. How do we delineate what this is? Well, on currencies, what you do is you move the decimal place over 0.000942 is where it's at right now. This is the equivalent of 9 ticks. It does not work in points, it works in ticks. Move the decimal place over 4 to the right. Okay. And if you move it 4 to the right, what you get is a value in ticks. Now the determiner in currencies is if it falls below 5 ticks on the average true range, you know that you shouldn't be trading. And you can see as it approached 5 here, how slow and whipsaw and channel and back and forth where it chops up all traders, this is what occurred. And so know when to trade. When the market's slow, stay out of it or look for another market. When it's volatile, I'd say 25, 30 ticks on the currencies, it's too volatile to trade in my opinion. Most traders have a tight stop. They're going to get stopped out in a matter of seconds as this thing fluctuates. Use the ATR to determine the most current market conditions. If you have any questions, I have an upcoming mentorship class in February I'm setting up for. If you have any questions, join me. My name is John Paul. Visit the website DayTradeToWin.com. Thank you.